Welcome back to the Daily Crypto Roundup. We've got a packed one today. Markets are stabilizing after recent volatility, institutional positioning is quietly shifting again, Ethereum's ecosystem is showing renewed momentum, XRP remains in the regulatory spotlight, and in Europe, the UK Gambling Commission is now actively exploring whether licensed operators could accept cryptocurrency payments. That last one may sound niche, but structurally, it could become one of the more important adoption signals of the year. Before we get into today's breakdown, a couple of quick updates for the community. Huge congratulations to Ryan84, who's just won 10 XRP, and to LA Kings Ellen, who's picked up 5 XRP. Check your messages and we'll get that sorted. And just so everyone knows, Glenn, our market analyst and the brains behind this entire operation, is expecting a baby within the next 2 weeks. So if there happens to be a day where the show doesn't go out, don't worry. Nothing's wrong. We'll be back very soon. Now let's get into it. Let's start with the market tone. Bitcoin is holding firm near a major psychological range, consolidating rather than breaking down. The key thing right now isn't explosive upside, it's resilience. After the last wave of macro pressure, Bitcoin did not cascade lower. Instead, it absorbed selling and found support. That matters. Analysts watching derivatives markets are pointing to cooling funding rates and a reduction in excessive leverage, which typically creates healthier conditions for sustained moves rather than sharp squeezes. Ethereum is also stabilizing, trading in step with broader market structure but showing slightly stronger on-chain activity. Layer 2 transaction volumes remain elevated, and network usage metrics suggest developers haven't slowed down despite price consolidation. When you see price compress but development and usage stay steady, that's usually constructive longer term. XRP continues to trade as a regulatory proxy asset. Even without fresh court rulings, it reacts sharply to policy chatter in both the United States and abroad. Traders are increasingly viewing XRP as a sentiment gauge for regulatory clarity. When optimism builds around structured frameworks, XRP tends to outperform. When uncertainty creeps back in, it underperforms. That pattern has been consistent. Solana and Cardano are moving broadly in line with the majors, with Solana continuing to benefit from high-throughput narratives and Cardano leaning on ecosystem updates and staking participation metrics. Across the top 10, what stands out is not extreme volatility, it's compression. Compression often precedes expansion. The direction of that expansion will depend heavily on macro catalysts and institutional flow. Which brings us to ETF positioning. Spot Bitcoin ETFs in the United States continue to see mixed flows. We are no longer in the phase of relentless inflows dominating headlines every single day. Instead, we're seeing rotation. Some funds record inflows, others mild outflows, suggesting this is becoming part of normal portfolio allocation behavior, rather than speculative frenzy. That transition from hype-driven flows to portfolio-driven flows is actually a maturation signal. Institutional desks are also watching macro correlations closely. Bitcoin's correlation to equities has eased slightly, but it hasn't fully decoupled. If US rate expectations shift meaningfully, crypto will react. Analysts are increasingly framing Bitcoin not as a pure risk asset or pure hedge, but as a hybrid instrument, one that absorbs liquidity conditions, but also benefits from structural adoption themes. Now let's widen the lens to regulatory developments. The biggest structural headline today comes out of the United Kingdom, where the Gambling Commission is exploring whether licensed betting operators could accept cryptocurrency payments. This is not approval, it is exploration. But the significance lies in who is doing the exploring. The UK gambling market is one of the most heavily regulated in Europe. Operators face strict affordability checks, anti-money laundering obligations, and consumer protection standards. Integrating crypto into that framework is not a casual experiment. It requires wallet verification, blockchain analytics screening, real-time monitoring, and likely instant conversion into fiat to avoid volatility exposure. Now, why does this matter beyond gambling? Because integration into a high-compliance consumer industry signals regulatory confidence in crypto's traceability. Public blockchains are not anonymous black boxes. They are transparent ledgers. If regulators conclude that crypto payments can be monitored as effectively, or more effectively, than certain traditional methods, that strengthens the broader argument for digital asset integration across other sectors. There are obvious concerns. Crypto transfers are fast, frictionless, and psychologically distant from traditional banking interfaces. That can amplify risky behavior. So, if approved, we would likely see tighter oversight rather than looser standards. Stablecoins would almost certainly be favored over volatile assets for deposits. Wallet ownership verification would become mandatory. Suspicious address screening would be standard. But the key takeaway is this: crypto is no longer being dismissed outright. It is being engineered into regulatory frameworks. That represents a different phase of industry evolution. Now let's connect this to the United States. Across the Atlantic, regulatory clarity remains uneven. There are structured pathways emerging for ETFs and custody, but payment integration still depends heavily on state-level systems and private sector initiatives. If the UK moves forward with a controlled crypto gambling framework, it may influence discussions elsewhere. Regulators often observe peer jurisdictions before making their own moves. Meanwhile, stablecoin legislation continues to be one of the most important undercurrents in crypto policy. Lawmakers increasingly recognize that dollar-backed stablecoins represent both opportunity and systemic consideration. If stablecoins become accepted payment rails inside tightly regulated industries, that dramatically increases their legitimacy. From an investor's perspective, these policy discussions do not immediately move price. They move perception, and perception shapes long-term capital flows. Right now, the market is in a digestion phase. Leverage has cooled, volatility has narrowed. Regulatory headlines are shifting from enforcement shock to integration mechanics. That is subtle but meaningful. Enforcement-driven cycles create fear. Integration-driven cycles create infrastructure. Infrastructure outlasts hype, and when you zoom out, the pattern becomes clearer. We've seen ETF approvals. We've seen institutional custody expand. We've seen banks explore tokenization. Now we're seeing gambling regulators examine payment integration. These are incremental steps. None of them individually ignite a parabolic move, but together they form a lattice of legitimacy. On the altcoin side, capital rotation remains selective. Traders are favoring narratives with clear structural hooks, scaling upgrades, regulatory clarity, real-world asset tokenization, payment integration. Purely speculative meme momentum is less dominant than in previous cycles. That suggests a maturing capital base, even if volatility still exists. Macro remains the wild card. Inflation data, rate decisions, and equity sentiment will influence short-term moves. Crypto does not operate in isolation. Liquidity conditions still matter. But structural adoption narratives increasingly cushion downside pressure, because investors can point to tangible integration rather than pure speculation. So where does that leave us? Bitcoin is consolidating rather than collapsing. Ethereum's ecosystem activity remains healthy. XRP continues to trade as a regulatory barometer. Stablecoins are quietly becoming more central to policy conversations. And the UK Gambling Commission's exploration of crypto payments signals that digital assets are being evaluated as infrastructure, not fringe experiments. That does not guarantee immediate upside. It does not remove risk. But it shifts the tone of the conversation from "should this exist?" to "how do we integrate this responsibly?" And that is a different stage of market evolution. And a quick favor, half the people who listen to this show are not yet following. If you get value from these breakdowns, take 2 seconds to hit follow. It genuinely helps the show grow and keeps us competitive in this space. We'll continue monitoring institutional flows, regulatory frameworks, and macro signals because those are the drivers that matter now. Not just short-term candles, but structural positioning. Drop your thoughts in the comments, smash like, follow, and we will see you at the top.